many companies like yours and emerging market funds, banks, are scouring the world for growth. In our country, in the US, but also in Japan and the European Union, growth really has slowed down to the order of 1 to 2%. The question is, where then in the world is the growth? And when you look at the data, as I have, over the last 2 decades, and you look at what has been the real annual growth of gross domestic product, GDP per capita, what you find is that the emerging markets, their rates of growth have been 2 to 3 times over that period the rate of GDP growth in the advanced countries. Now, this suggests that the world is being transformed into a marketplace that is traveling at 2 speeds. And this holds important implications, it seems to me, and I hope for you, about how to think about where and how to make investments that propel your company to higher levels of growth. Now, when we take this long view and we look at the fact that this wedge between the emerging markets at 2 to 3 times and the advanced countries is occurring over such a long period, that is indicative of the fact that this is a structural transformation. This is a secular trend. It is not due to the business cycle. The interest in emerging markets is not a cyclical one. And that is a very important point, I think, to understand, because the game is changing. Now, this does not mean, of course, that the business cycle is dead. It's not in any economy. And so today there's a lot of preoccupation about how the Chinese economy is doing. It's on a very strong secular trend of growth, save for some problems, which I'll get to later. But it is going through a business cycle now, which is quite normal. And so the question is how to distinguish between where is there secular growth and where is there cyclical phenomena that is creating perturbations along that long-term secular line. Who are the emerging markets? Who are these markets that have been growing so fast that I've been referring to? Most of you in the room, I would bet, think of emerging markets as the Chinas, the Indias, the Brazils of the world, what economists have called the BRICS for a shorthand. In fact, the emerging markets where this growth is taking place is not just in the BRICS, but in a wide swath of developing countries throughout the world. If you use the IMF and the World Bank definition of emerging markets, they are referring to upwards of 100 different countries. Now, obviously, all of these countries are not the same. Some are growing much faster than others. But when we double-click on that set of countries, there are certain countries in Latin America, such as Colombia, such as Peru. There are countries in Asia, beyond China, beyond India, such as Thailand, the Philippines, Vietnam, Indonesia. In sub-Saharan Africa, many of you might think that the fast-growing countries are the Nigerias and the South Africas. Yeah, to some extent they've been fast-growing, but they've had their problems, which I'll get into in a moment. But there is a set of countries elsewhere on the sub-Saharan African continent that are actually more fast-growing and have much greater records for sustained growth, such as the East African community of countries, including, the Rwandas, Uganda, Kenya, Tanzania. And in Western Africa, in Ghana, in Senegal. And then when you move south, just north of South Africa, are Southern African countries like Botswana, Malawi, Namibia. These are countries where we are beginning to see over the last decade or so real sustained rates of growth. So when one talks about the emerging markets, it's not the small set of countries that appear in the newspaper headlines day to day, but a whole other set of countries where there are really significant investment opportunities and where, adjusted for risk, the returns are rather high. Now, I've said that the growth in emerging markets has been much greater over the last 2 decades than the advanced countries. Those are the rates of growth. And as I said, the rates are forming a wedge. But more importantly, when you look at the data, the emerging markets as a whole are becoming the engine of the world economy. So if you think about the world economy as a pie, and the world economy keeps growing, the pie gets bigger, what is actually happening is that the piece of pie that is the emerging markets, that piece of pie is actually growing faster and getting larger at a rate faster than the pie itself is getting larger. And so the share of growth in the world economy accounted for by the emerging markets is growing faster than the overall world economy is. And this is a really important point. But you might ask, how have the emerging markets fared through the recent financial crisis that began in 2007, 2008, and in many respects is still here today? Well, it may be a surprise that many of the emerging markets actually fared much better than the advanced countries through the cycle. In fact, I don't know if you will believe this, but I have done a study on which region among emerging markets actually proved to be the most resilient through this cyclical perturbation in the world economy. Guess who it was? Sub-Saharan Africa. Now, this is not terribly intuitive, but I remember when I was at the World Bank, and Wolfowitz was the president, and I was a senior executive on the Africa desk, and he came to us because he was very, very interested in Africa and wanted to know, how is Africa going to weather this storm? Very worried about it, how much aid is going to have to be pumped into the continent. And my team and I put together a note for the president, and we felt quite strongly that because of the hard-won reforms in many of these sub-Saharan African countries, that Africa, on average, was going to weather the storm quite well. And lo and behold, when you look at the numbers now ex post, in fact, relative to every other region of the world, including the advanced countries, African states actually proved to be more resilient. And in part, it's because of the hard-won reforms that have been in place in these countries for the last 2 decades. So what happened during the crisis in Africa? Well, unlike in Turkey, unlike in Russia, unlike in some of the advanced countries who put on price controls to try to contain inflation, who put on protectionist measures to try to protect the economies from the external influences of the crisis, in Africa, you saw virtually none of those types of practices. Because I think, and this is how I look at an economy, is I look at the government policymakers, and lo and behold, they actually had learned the lessons from previous crises and did not put in place these controls that actually would have exacerbated the effects of the crisis, not helped them. So what are the contours of this transformation of the world economy that I've been speaking about? I think there are quite a number, that I think some of which will surprise you. The first is that not only have advanced countries and their companies and banks and private equity firms begun to discover that it's the emerging markets where there's a lot of growth. But it's firms from the emerging markets themselves who also have discovered this. And so when you think about China's and India's forays into sub-Saharan Africa, for instance, this is because the Chinese and Indian investors, as well as the Brazilians and some other emerging market companies, have figured out that that's where the growth is. And they are seeking markets for growth, just as the advanced country companies and banks are. So one of the features of the fact that emerging market companies have begun to penetrate other emerging markets is what economists call trade between the southern countries. Typically, the nomenclature thinks about the advanced countries as the north, and the developing countries or the emerging markets as constituting the south. South-south trade, that is trade between emerging market countries, in the last decade has grown significantly from about 6% in the late 1990s to now more than 20% of world trade. That is to say, a fifth of world trade now is accounted for by exchange of goods and services between the emerging markets. Historically, the tradition is north-south trade and investment, or the trade and investment across northern countries, so that the US investing and trading with Canada, Europeans trading with the US and with the Japanese. This has been turned on its head, or is beginning to be turned on its head, by the rise of south-south trade and investment. Now, I've given you one statistic that 20% of world trade is now comprised of trade among emerging markets. When you look at investment, the outflows of foreign direct investment from emerging markets, 1/3 of those investments are actually being made in other emerging markets. This has, I think, a profound view about how you should begin to think about your competitive strategies for two reasons. One, everybody now is beginning to look at emerging markets, and so whereas the northern companies or institutional investors used to have a wide open game, a relatively wide open game in the emerging markets, they're now facing new competitors. It's not just the GEs competing against the Siemens in Africa, but they're competing against similar firms from Brazil or India or China. In fact, it's quite arguable that companies like Siemens and GE will think that they may actually have shared interest in trying to compete jointly against the Chinese or the Brazilians in these third country markets, the emerging markets. The second factor is that as the multinationals from these emerging markets, or the southern multinationals, become more competitive, have sharpened their business skills, they have begun to invest in the north. So the Tatas buying Jaguar, Huawei making inroads into North American markets, and many other emerging market firms. That means that not only are advanced country companies facing different and more intense competition in third country markets, but actually facing more intense competition right here at home. And that calls for a different way of competing in this changing world economy. The second contour of the transformation of the world economy that I've been speaking about is the location of where inventions are coming about. When I was in graduate school, too many years ago, you can tell from my gray hair, the notion of the product life cycle was a staple of the economics of foreign investment. And this was due to a professor of mine, Ray Vernon, at the Harvard Business School. And the notion is that going back several decades, if not a century, inventions, that is the discovery of new products and processes, took place in the advanced countries. And that as the advanced countries began to sell more and more of these inventions and they became commercialized through the innovation process, the original markets became saturated and they began to sell slightly different versions of these products to middle-income countries that are not quite as advanced as the industrialized countries were. And then over time, these products became fairly dumbed down and commoditized and became mass market commodities in the emerging markets or the developing countries. And this product life cycle really undergirded a lot of strategic decisions taken by corporations for much of the last century. That is changing. Today, by reasons of necessity, because of the lack of certain sectors present in the emerging markets, and by dint of the fact that there are not vested interests who have now obsolete technologies, inventions are taking root in the emerging markets. And the one example that I think resonates with all of us more than any other example is that of mobile money. Mobile money was invented less than a decade ago in Nairobi, in Kenya. And for the last 5 or 6 years, when I've been to Nairobi, you cannot pay for taxi fare with cash. You can only use your smartphone. Mobile money also has the great advantage of allowing farmers to tap into data systems to figure out what the prices are in the cities when they're in the rural areas and they want to ship their products to the cities. But the most important function is mobile money has filled a vacuum, a need in emerging markets, starting in Kenya, of the lack of a banking system, and particularly the lack of a banking system for the rural community and the poor. Well, flash forward 6, 7, 8 years, guess what? Now Apple, now Google, and some other companies in the advanced countries have discovered mobile money. And the way I think about this, and there are some other examples too, but this is the most, I think, telling. The way I think about this is the product life cycle is now being turned on its head. And it will not be a surprise, I think, given the state of infrastructure in some of the advanced countries, particularly the US, that we might begin to see subway cars manufactured in China making their way into the US subway system, and that these will be far more modern and far more advanced and have lots of accoutrements that we would not dream of today. So the product life cycle and where the locus of invention and innovation and the transference of mass products to different consumer markets is beginning to change very significantly. Another feature of the transformation of the world economy is where are the consumers? Now, much has been written, many headlines have been written about the fact that there's a rising middle class in emerging markets. Usually the focus is on China or India. I think as an economist, the notion of a middle class is not terribly economically meaningful because I don't know where the upper class begins and the lower class begins. Rather, The right terminology is a consumer class. And to be sure, there is a burgeoning consumer class in the Chinas and the Indias. But the consumer class is also beginning to rise significantly in other countries in Latin America, in countries in Asia, in East Asia, in Indonesia, in countries in the Middle East, and in countries, again, in sub-Saharan Africa. That's, I think, fairly understood. But what I think is not understood is how the consumption behavior, the purchasing behavior of these consumers has begun to change. And from some research I did in a book I wrote on Chinese and Indian investment in Africa, we focused on the blanket market in Africa to tell the story and test our hypothesis. It turns out that in South Africa, the Chinese 4 or 5 years ago came in and began to sell in kiosks very inexpensive blankets. And they sold like hotcakes. They had nice African designs, and as I say, they were very inexpensive. What happens is that when you washed those blankets, the dye ran out and they shrank. And these became known among the population as wash and cry blankets. So in some sense, you might think, well, you know, these customers got what they paid for. They didn't pay a high price and they got very low quality goods. In come the Indians. And they invade the same kiosk markets, but they're manufacturing blankets for a higher price that is better quality in terms of the fabric and more durable dye. And they began to take away market share significantly from the Chinese. But by charging a higher price, the African consumers were willing to make that trade so that they got a better quality good. And so it suggests that, you know, economic incentives work in general. And I remember when I was working in Russia during the reform era prior to the crisis, the scuttlebutt in Washington and in Brussels was that the Russians will never think like market-oriented consumers. And lo and behold, they responded to prices. The other story on this matter, which I just want to relate to you, which I think is really important, is the purchase of goods, whether it's just by the individual, whether it's by government agencies, or whether it's by companies, is also being colored by this greater sophistication in decision making. And so when I was in Africa talking about my book, I was up on the dais with the current Minister of Trade of a particular country. And in the crowd in the first row was the former Minister of Trade. And we were having a talk. And the former Minister of Trade raises his hand and says, you know, why did you finance tractors that were very cheap, very inexpensive off the shelf from China? And the current minister sort of was looking a little bit puzzled. And what had happened in the intervening years after that purchase was that, yes, the tractors were cheap, but lo and behold, several years down the road, they broke down. They couldn't be maintained. They couldn't get parts. And so what has happened is that this minister, and I've seen this in spades in other countries and in other settings, says, oh my God, you know, I was so driven to buy the cheapest thing off the shelf that I didn't even look at, say, a John Deere tractor, which would be more expensive. And they've begun now, as a result, to change the mode in which they're making their purchase decisions. And one way of thinking about this is, just like the blanket example, in machinery by a government agency, they're beginning to make their purchase decisions on a life cycle basis, on a present value basis, much like we do for large items. We compare whether or not a higher price is worth it because I'm going to get a better quality good. And we are beginning to see that light bulb go on in many emerging markets. And so focusing simply on the size of the consumer class, which is rising, it is really important for companies like yours to think about how can I deliver a quality product, recoup my costs, but sell that in a very competitive way. One of the other dimensions of this transformation of the world economy being engendered by the rise of emerging markets as the engines of growth of the world economy is the state, and I don't mean the state as the Supreme Court almost interpreted it, but the governments in the world economy are still very much involved in these economies. But what has happened is that the role of the state in the emerging markets has begun to change, has begun to morph from an explicit role to an implicit role. And that has very significant implications, again, for competitiveness among firms as you're trying to get into these growth markets. Because governments now implicitly can provide soft loans for their national champions as they penetrate other emerging markets. But they have also begun, as they have grown their economies, they want to make sure that they are protecting their industries. And so if you follow what has been going on for years on the WTO and NAFTA, a lot of the focus of protectionism has been between protectionism on the part of the French or the British vis-a-vis the US or the Canadians, North-North protectionism, and to some extent, North-South protectionism. Us, the US, taking on the Chinese for alleged dumping of steel. But what has begun to happen and become more apparent are the implicit subsidies or charges of implicit subsidies among the emerging markets. And so one example I think really drives this point home. A couple of years ago, I was asked by an athletic footwear company to help solve a problem they had. And the problem stemmed from the fact that, like most athletic footwear companies, the bulk of their production was in China. And it turns out that not only were they exporting out of their Chinese factories to the US, but they were exporting them into Brazil. And the Brazilians, the government, fostered by their own footwear industry, pressed the Chinese and accused them of actually dumping their athletic footwear into the Brazilian market. But this is the athletic footwear that bears the brand names that we all know, the Adidases, the Nikes, and so forth. And so this company came to me and said, well, you know, we're now in the middle of this trade fight between Brazil and China, and we can't go to the US Trade Representative's office in the White House, where I used to work, but we have to find someone who can help us mediate this kind of problem. And the question became, so how do you convince the Brazilians to back off, or how do you convince the Chinese to pay the fine, or, as often is the case, how do you figure out how to mediate these differences? And it's the kind of story that is emerging more and more, that advanced country multinationals are being caught right smack in the middle of crossfire between one emerging market versus another because they're engaging in protectionist practices. And again, that means that you have to think very carefully about how to deal with these kinds of problems if you want to grow.